Hello,
Hello,
everybody.
chat.
Okay, that works. We are live on TGI, on the TGI page. If anybody came over from DGI and you've been waiting for 25 minutes, I'm sorry. This took longer than we thought. We were going to do an advanced test to both the Facebook page and the YouTube channel, and found out that that's a premium feature. And we're not quite there yet. This is just a test. So we decided to go live to make sure we didn't disappoint anybody. But if you are watching on the page, let us know you're here, and let's just do other things and talk about other stuff. So the live stream today was great. I got 2 new stocks that a friend, Luke, got to me, Badger Meter and Logitech. I wanted to check to see if those were on yours.
Yeah, maybe 1 or 2 words about me first, who I am.
Absolutely. Absolutely.
Okay. My name is Torsten, and I own a website. It's about investing, of course, investing with stocks. And you will see it in action very soon, or even right now, with testing the 2 stocks you just mentioned, Chad, yeah?
Yep.
Okay.
So this is the site.
This is the site, and
let's go to the home page first.
It's still loading. Maybe.
So this is the home page. It's dividendstocks.cash is the English version, and there is also a version in German. How long has the site been up? How long has the site been active?
This site for a little bit more than 2 years, 2.5 years, nearly.
Okay.
And the German version is 1 year older. So the German version came first because I'm from Germany. And the main audience is also located in Germany, or at least German speaking.
Okay.
And this is the premium add-on for the rest of the world.
Nice. Are you planning other languages?
No, not really. I think from a technical point of view, I could implement, but mostly anybody speaks English.
Right. English is the main trading language around planet Earth right now.
Yeah.
So,
exactly.
Okay. So let's go to the dividend screener, and let's take a look at those 2 stocks that Luke Bray got me that I wanted to check out. The first one is Badger Meter Incorporated, BMI.
You want to do it, or should I do it?
Well, let me do it, and then you can show some stuff if you see that I'm really missing something important. So BMI.
Badger, I just wanted to say, I don't know this stock. It's not an S&P 500 stock, probably.
So it might not be here.
The number of stocks is limited to the largest and most promising stocks in many countries, but I don't have any stocks. But Logitech, you should find. You can enter the name, maybe.
Okay, I am seeing this when I'm bringing stuff up. Sometimes it doesn't come up immediately, and you have to go to filter and empty filter.
Only if you configure the filter to filter for something. But right now
I didn't think I was, but
type in the name. Just remove the entry from the simple search.
There's why.
The symbol it's another symbol. You need to know that the symbol is not unique. You might think as an American that the symbol is unique because Microsoft for you is always MSFT. But indeed, it's not unique. It's always an info about the security, the stock itself, and the exchange. Microsoft should work. This is stock Microsoft on Nasdaq, it means.
Right. Okay, but if I type in micro.
If you type in micro and you are searching for the name of the company, you need to use the R field.
That's why. Okay, so there's a symbol search and a name search. And I'm expecting, for some reason, the same thing on both. Okay, so Logitech. There we go.
It's a stock from Switzerland. Yeah.
Yep.
So the symbol is coming from Morningstar, and I think it tells you that it's a stock Logitech from Swiss an exchange in Switzerland.
Okay. Yep. ISIN is CH, so that's Switzerland. Okay, so for Logitech, here's the
hardware company.
Yeah, it's a technology company. They make computer peripherals, speakers, and keyboards, and mice, and things like that.
Stuff. Exactly.
So as the technology infrastructure builds out, they're doing gangbusters when it comes to business, and they've been doing really, really well. So here's earnings, cash flows, and dividends.
Maybe that's already fine. It depends how we can start either by looking at the metrics first to get a rough idea.
Okay.
Or we'll look, we dive a little bit deeper directly by looking into the charts. It's up to you.
So where should I go to get general? So you're talking about the data here first?
Yeah, exactly.
Okay.
Exactly. So for example, can you press once on the row, because the row is highlighted now with blue? Just once, exactly. Now it's a little bit better to read, I think.
Okay.
For some people. So you see first the market capitalization, for example, it's roughly $10 billion, 9.3. Okay. So it's not small, but it's not the largest stock either, or the largest company. Somewhere in between. They only pay dividends once a year.
Right.
Which might
Annual
be
dividends
to US investors.
You're right. We don't see that in the United States very often. Most US-based companies pay on a quarterly basis, but I'm actually seeing ADRs where most companies from outside of the United States only pay once annually.
In countries like Switzerland, Germany, it's common that the companies pay only once a year. In other parts of Europe, it was common that they only pay once a year, but now outside, in the other parts of Europe, like Denmark, for example, Netherlands, and so on, Great Britain also, they increase the dividend frequency 2 times or even 4 times a year. It's just Germany and Switzerland, we are lagging behind.
Yeah. Okay. One of the biggest hypes that I see in the DGI group and all over the place is there's some kind of an obsession that we have here in the United States with monthly paying stocks. They literally pay every single month. And I've been working to try to forestall that, because if you look at the numbers, if you look at the actual payouts and the actual total returns, just because a stock pays 12 times a year does not mean that it will pay more or give you a better total return than a quarterly paying stock. And to be honest, one of the top stocks that I had for a while, so here's an example, Activision, okay? It only pays once a year. But if you look at Activision and its total return, it's in the stratosphere. You know, it's almost 1,000%. Well, okay, I don't want to give a random quote like that. I want to actually look at it. So let's look at Activision on Seeking Alpha, and then we can also bring it up on your system. Exactly. Activision Blizzard, they only pay annually, and come on, there we go. So their dividend yield is really, really low, okay? But their growth rate is fantastic. 13%, 12, and 10%. And their momentum, this is how I've been judging stocks up until I found your site. and 632.51 total return over the last 10 years.
Now we can verify this. Huh? We can challenge this number on my side.
So let's actually do that. Let's do Activision. Activision Blizzard. Okay, no, I don't actually want to go to the website. There we go. So there we go.
It's already down, but yeah. What are we going to challenge? Capital gains first?
Total return.
Total return. Okay, then you need to go to the valuation tab below. Exactly, and then scroll down. For 10 years, you can turn off anything except the stock price, and then you can calculate the annual return within the
right. We will fill all of this stuff back in later as we explain it.
Exactly.
So here's stock price.
10 years ago, it was in 2010. Okay, that's a nice trick, huh? Nice trick. Then just select the outmost on the left, the stock price. You can click on this. You can click on this line. Yeah, exactly. Select this one, and select the present. Exactly. And now you see total yield 564%, including dividends, without reinvesting dividends. I think Seeking Alpha told us about 600%.
Right, because that includes dividends being reinvested.
Okay, there we have it. In Germany, mostly you can't reinvest automatically. You have no, how do you call it? DRIP or something like that?
DRIP, Dividend Reinvestment Program.
Exactly. Yeah, we are lacking a little bit behind.
I'm sure they'll catch up. And, just like with the push over the last year for brokers to end the commissions because Robinhood was stealing their lunch, if enough people demand dividend reinvestment, maybe the brokers in the European market will listen. But for right now, so this total yield on your site is without dividends being reinvested, correct?
Exactly. And without taxes for sure.
Okay.
So it's a little bit even too optimistic because we need to pay here, at least in Germany, we need to pay 26%.
Okay. All right. So still 563%. That is a nice gain for Activision over the last 10 years.
Although the stock price hit, how do you say, it dropped considerably at the end of 2018.
So this is September 2018, and its bottom was in February of 2019, and it's coming back up again. I'm not sure what happened, but they found their footing, and they're on their way back up. So let's look at some of the other bits of data that you have in here. So earnings per share.
If you want, you can first remove the red line by pressing, exactly, press there. You can once, yeah, exactly. Yeah, it's
okay.
Gone. Maybe you also remove the stock price first. We are now going to do evaluation already, or just look. First, we look a little bit at the fundamentals. At the earnings.
Let's look at the fundamentals first.
Then maybe you zoom out. You press the zoom all button to get an even better idea of the stock. Here you see it.
How far back does your data go? 25 years?
It depends a little bit. Normally 30 years in the past and 3 years into the future, including 12 trailing months.
Okay.
I haven't seen any other screener giving you this, how do you say, this series or this time row in this completeness.
Right.
Always something missing, either 12 months or...
Maybe fast graphs, but...
Fast graphs has no 12 trailing months as far as I know.
Okay.
As far as I know.
Okay.
But fast graphs is very similar to this indeed, except they can't show fair values on parallel.
Right.
Okay, but so these are earnings. Then we see that from 2000 to about 2009 till financial crisis, the stock was not so, earnings did not really do well in my point of view. So it was a little bit like kind of stagnation. It's going up and down again. And then suddenly, starting in 2010, 2009, 2010, earnings boosted, obviously, till today. Huh?
So they had steady growth up until 2017, and then they had a massive spike in 2018. So that, if we bring the stock price back in, that's an interesting difference.
Yeah, the stock price is always or often a little bit advancing the fundamentals because maybe this thing which increased earnings was already known before it went into the fundamentals, into the quarterly reports.
Okay, so
and the market expected this, and the stock price increased.
So it looks like from these two bits of data, okay, it looks like maybe they signed a contract, or maybe they found a new business product or service or whatever that they announced right here. The stock price shot up, but it took a little while for the actual business to catch up with that promise.
It's a little bit speculation what we do now, but we can keep on speculating if you want on even more fundamentals. Yeah, at the adjusted earnings, add them, and okay, now you see that the adjusted earnings, they show a little bit another picture. The adjusted earnings exclude one-time items, a one-time charge like write-offs or litigations, such things.
Okay.
And there you see that in general, the adjusted earnings are higher. We could look why. So what's the difference between? And we see that the reported earnings start extraordinarily or sharply increase before the reported earnings. They already increase in 2016, in the business year 2016, exactly. And now the stock price follows. So it's a little bit speculation, but we can see that in general, after the earnings, the reported earnings increased, stock price increased also. It's not about 2 months earlier or 6 months earlier or later, but there is a correlation, obviously.
Yeah.
And then the earnings, both reported and adjusted, they go down, and the stock price dropped considerably. But it's a little bit guessing. We should know the event which triggered this considerable capital losses.
And for that, we'd have to go to like Wikipedia to look at the history or look through
exactly
article reports.
We must leave the screener anyway, go somewhere to find the reason for that, and then do our own thinking.
Well, let's continue with the fundamentals on this one. Yeah. So the next one here is operating cash flow.
Exactly. So now we are leaving the world of the balance sheet. We are entering, or the P&L, the profit and loss calculation. We enter the cash flow statement now, the real flow of the money in and out the company. And there's more money flowing in the company than out, luckily. So the operating cash flow is positive. It's it runs on parallel to the earnings, as you can see.
But it exceeded
a little bit higher,
yeah,
and sometimes a little bit lower. But it's roughly it's running on parallel, more or less. Okay, and
the next one you have
dividends. We have the dividends.
So this is actual dividend paid, right?
This is it always shows the payments for the last 12 months for the date you just selected or you're just hovering over.
Okay. All right. So like for right now,
is there a pending dividend cut? Because there's $41 US, now there's $31 US. I don't know.
Is that something that they announced?
This is the estimates.
Ah. Okay.
And the hour till you see the panel where it's written estimate. Starting from there, estimates are taken from fact set until there. The real data is taken.
Okay.
Each single dividend payment once a year, you told me.
Right. So they have one announcement on February 12th of 2019, declaring 37 cents a share with an 8.8% increase. And then this year on February 6th, they announced 41 cents a share, a 10.8% increase. So what this is saying is that estimates are that they will have to reduce that back down to 31, probably because of the loss that we're looking at in earnings per share, adjusted earnings per share, and operating cash flow here. So they're estimating the dividends will follow the drop in cash flow down from 41 cents to 31 cents.
Yeah, that's one. Yeah, exactly. I can show you if I have the affected workstation, something like a Bloomberg terminal. If I can share my screen, I can show you the details.
Okay.
If it's interesting. So there's even more data. I make share screen? Is it okay?
Yeah.
And then we see what happens. Okay, wait. I need to remove this window. And oops. I'm there to come. Do you see some nice figures? Yeah, exactly. I see you see them.
Yep.
So
It's a little hard to read, but
it's a little okay.
There we go.
I read it for you. So this is the FactSet terminal, and we are in the estimates tab. This is the per share estimates. We also looked at per share data. It's a dividend per share, and here you see the estimates, and it's for December 20th, and it's 31 US cent only. So that's what you saw there. It's based on 10 estimates, and you see where is the problem with estimates in general. What you see, it doesn't matter if it's on dividend stocks cash, Fastgraph, or somewhere else. It's always an aggregation of different brokers estimating. And here we have 10 brokers, and their estimates, they range from 0 dividend, so no dividend at all, till 41 US cent. That's exactly the last status of the dividends we've just seen on my screener. And now there's something in between, and something in between is 31 US cent.
That's interesting, because what that's saying is they're not expecting Activision to be able to increase their dividends for 2020.
Exactly. Not every analyst agrees with this, that they can increase their dividends. Exactly.
Okay.
But that's the problem with estimates.
Okay.
It's enough that only a single broker or two brokers, they just don't do their homework, and they make bad guesses, and the aggregate is how do you say, it's a little bit broken. Yeah?
Right.
So you always need to know these things to better
Let's get into the value lines. So
do you want to take over, or should I take over?
I've got it. So I'm sharing my screen again, and you've got a couple value lines here that I wanted to show off. So the first one is fair value price to earnings.
Before we do so, can you remove the fair value you just added? The fair value price earnings, exactly. Okay. So now we did a fundamental analysis. We looked at the stock now first, and now we are doing valuation. It's another step. It's just for our viewers, so that they better understand what we are doing now.
Perfect.
And we now want to get an idea if the stock is expensive or cheap or something in between.
Right.
And to do so, first, we need to find, we are working with multiples. So basically, it means that there's police or firework or don't know what. Basically, it means that we let the market decide with the multiples, with the historic multiples. We let the market decide if the stock is expensive or how expensive or what's the fair value of the stock. So if the stock, the historic multiple price earnings, for example, within the last 10 years or something like that was 10, and the fair value for this period is a price earnings ratio of 10. And if the current price earnings ratio is double as high, maybe 20, then the stock is overpriced, is expensive. That's the basic thinking.
Okay.
And now we need to find the characteristic time frame for the company today. We just saw that the first 10 years were not so successful of the company. They didn't increase their earnings here, exactly. Was not so successful. But the second half was much more successful. And that's exactly the half you already selected, which it was already pre-selected. You can do it once again, yes? And what happens now is that the screener calculates the multiples for the time frame you just selected. And we can see the multiples on the right side. Exactly. So we see that from 2009 till today, or till 2020, but for the last years, the multiples are not taken because they would be wrong. They are based, the future is based on today's stock price. So we don't consider this. You have price earnings 24.9, price earnings adjusted a little bit lower, and price to cash flow even more lower. And the average dividend yield was 1%. And based on these 4 pieces of data, we can calculate 4 different fair values. And now you're free to add one after another. Exactly.
Okay. So fair value. Right now, this is showing at, okay, you're saying 24.9.
The current price earnings is higher than 24.9. It's between 25 and 30. We see it below in on the x-axis. There are many numbers, and there you see trend lower. Exactly. And there's the first line is the price earnings. If you zoom in a little bit, you see each year. Yeah, for example, now you see each year, and you see that the price earnings for the last 12 trading months was 25.2.
Okay.
Or for the end of the business year, sorry, was 25.2. And for the next business year, with the current stock price and the estimate for the current business price, it would be 30. So it would be very high. And it's above 24.9, the current price earnings ratio. So the stock seems to be overvalued from this point of view.
Okay. Well, let's bring in the adjusted and see how that's different.
There it's even more overvalued because the historic average multiple was 80.8, so lower than the 24.9, but the current price earnings is somewhere between 22 and 25 price earnings adjusted. Exactly. Exactly. There is another place in the screen where you can see exactly how high the price earnings is right now, today. But this will do.
Okay. So the next one here is fair value price to cash.
Exactly. And here, if you remove the earnings per share and the adjusted earnings per share, then we should see a drop of the operating cash flow. Exactly. No, that's okay. If you go with the mouse to the chart area, to the presence, and then you see a little bit higher that the operating cash flow is dropping per share. No, you
right
see
here.
It's dropping. Exactly. That's why
let's make that very clear. taking out everything except for the operating cash flow and the dividends. So here's what he's talking about. The operating cash flow between December in 2019 and today, March of 2020. Well, okay, this is today, but the last report, their operating cash flow dropped from 2.37, I'm assuming billion, to 1.98. So that's the drop that he's
US
talking
dollar
about.
per share. It's always metric per share.
Oh, per share. Okay.
And now at the fair value, at just this fair value and remove the other ones to make it clearer for the people maybe. And now you see that both fair value and operating cash flow, they run in parallel.
Okay.
And the fair value drops now in the present or the last 12 trading months because the operating cash flow drops.
Okay. So you also have a fair value dividends.
Exactly. You can add in at the stock price again, maybe to get an idea of valuation. So you see that fair value. First, we must ask ourselves if fair value dividends make sense, because Activision is not really a dividend stock, and the dividend yield is rather low. So maybe for a stock like AT&T or Altria, something like that, it makes more sense, or the dividend is more important than for a stock like this. But from a technical point of view, we can also do or calculate a fair value dividend. And you see that the fair value dividend is basically the same for today as the fair value cash flow. But for the future, their fair value differs considerably. Why? Because the operating cash flow, according to estimates, will increase, and the dividends will be more or less flat. So the fair value based on operating cash flow is growing.
Okay.
All right.
And again, these are the estimates that we were looking at earlier from.
Exactly.
Okay, so they're expecting maybe a bump in early 2021 for that dividend, but they're expecting a drop. The average aggregate is expecting a drop from 41 down to 31.
Can you do me a favor? Can you look at Seeking Alpha? I think they also have estimates. What do they estimate for the dividends?
I believe that Seeking Alpha has that as a premium feature.
I am premium. I can look. I will look for you.
Okay.
Activision. I'm also author on Seeking Alpha, and then I get premium. Where do you go? I don't use it. Dividends, probably. You know?
Dividends estimates.
Yeah, here we are. 33 US dollar. They also have this dividend cut.
Okay.
Not 33 US dollar, 33 US cent. So they also have a cut. Okay.
Okay.
But nobody. Activision is not a stock. You should calculate the fair value based on dividends.
Right.
It's maybe nice to know, but earnings and cash flows are much more important. Okay, exactly. Nice job to show all fair values, because it's important to understand that these fair values, they are only guesses, only guesses, and these are different guesses how much the stock could be worth, and showing these guesses on parallel is, in my point of view, very useful, because now a little bit similar to different analyst estimates. Now you can see all these estimates, and where they are very close to each other. This is a nice sign that the estimate may really fit. If they all considerably differ, then it's harder for you to get a good idea about the fair value, as if the fair values are very close to each other. And okay, they differ a little bit, but based on what can we do, or what can we say? We can say that the stock is overvalued, clearly, because all fair values indicate an overvaluation of the stock. Now the question is how much the stock is overvalued. Then we could take, for example, the golden middle and base our valuation on the fair value adjusted earnings, and then the stock price should be, I don't know, something about for US dollar. What you do now?
But here's the thing.
Uh-huh.
Most of these estimates, except for the dividends, are showing an upward trend.
Mm-hmm.
So that means that the people who are doing those estimates are expecting Activision to increase operating cash flow. They're expected to increase the earnings per share. And if the trend line of the stock price follows that, then it could go up.
Exactly. That's a very important point. I just focused on the aspect if the stock is overvalued today and you moved the focus to the future, which is even more important.
Right.
So well done. And as you said, it's probably the company will do well, increase their profits, which means company gets more valuable. And in 2022, the fair values indicate a fair valuation. So they reached today's stock price.
Okay. So now let's look at Logitech again. The stock that Logitech, there we go. And look at a similar chart for that.
There's a special dividend. They started paying dividends with a special dividend. So they made a big party right from the start to make investors happy. Yeah, maybe you turn off anything except the stock price first. Then we'll look at if the stock made investors happy in the long run. There you turned off the Zoom. Yeah, okay, thank you. Then you see that it was not always an easy stock for investors.
No.
If you bought it at the end of 2000s, then the first 8 years till financial crisis made you happy. Then there was a time of many years of suffer. And then the stock rebounded and regained ground. And today it reached all-time high. And this often means that the stock currently is in favor of many people. Maybe they asked you for the stock because it's an all-time high now.
So I noticed this is a good example of the difference between earnings per share and adjusted earnings per share, because their reported earnings per share took a massive dive in 2013, but that was some kind of a major adjustment for something.
I can tell you what it was. Let me have a look. I will just consult my workstation here from FactSet, and we will see if they have it. 24. It was 2013.
Right.
Okay, I need to. I'm coming. They haven't. It's not there.
Okay.
They started indicating the details in 2015, 2013. I just see the numbers, so I don't know what happened there. It's probably a write-off or something like that.
Yeah, we can check the news history on that if we want to. But
if you want to, exactly.
So now if we go to operating cash flow, they had massive cash flow in the, between 2006 and bouncing around up till 2011. A little bit of a dip. These are the slow years that we're seeing in the stock price.
You see that the company earned money from a cash flow perspective also in 2013.
Yep.
Even they reported heavy losses in the same year.
Okay.
But they still earned cash. You see it by the operating cash flow, and you see it by the adjusted earnings.
Well, if we bring the dividend, that might
That's
be
interesting.
why.
That's interesting. So maybe there was a, how do you call it, divestiture or something like that? Maybe we are speculating. We are pure speculation. Maybe they sold part of the company. Can you look at the revenues? It means go up a little bit. Exactly. Fundamentals on the left tab, not in the screener, a little bit down.
Sorry.
Yeah, there are the
Where am I?
tabs exactly on the left.
Fundamentals?
Fundamentals down, and now you see on the top right chart shows you margins and revenues, and it was the year 2013, right?
Yep.
I want to see if revenues went down more. Also, if they considerably went down, then maybe they sold part of the company with losses. And they sold the company with part of losses on the one hand. On the other hand, they still received cash and paid out the cash to the shareholders.
This is also important. Repurchase ratio. They did it's the same period of time.
They tried to make investors happy one with special dividends, and second with massive share repurchase. What is also interesting, exactly on the left, on the left, the middle chart on the left, up, exactly, that's a balance sheet, and you see that the balance sheet was reduced in 2013. The balance was reduced, the total balance.
Okay.
So probably they sold something. They sold part of the company. Probably. It's my guess. Still speculation, but it's my guess. It's my story.
Well, let's see. In January 2013, Bracken Darrell became Logitech's chief executive officer, and then CEO Guillermo De Luca continued as Logitech's chairman of the board. So there were some board changes in 2013. I'm looking at Wikipedia, and that's about all it says for 2013, but a change in the members of the board of directors caused a change in direction.
Obviously,
Again, speculation.
on the balance sheet. Okay. Often it happens that if the board of directors, if there is a change, they make a little cleanup of their predecessors.
Right.
Maybe this was part of the cleanup. Don't know. Either. Anyway, something happened there, which is very interesting, because this combination of a reported loss and record share repurchases and even a special dividend, it's very rare.
Yeah.
It happens so often. But
okay, so let's highlight just the last 5 years, because that seems to be when their big upswing started, and do the calculations in the valuation period based on that. I'm going to zoom in to just the last 8 years to highlight that. And let's bring in the fair value numbers.
Yeah.
So fair value based on earnings, fair value adjusted, fair value based on cash flow,
exactly,
and fair value based on dividends.
Yeah.
So according to this, the fair value based on price to earning, non-adjusted, is actually higher than the stock price.
Yeah, but I think we can also say that this fair value doesn't make sense, at least not for today, because you see that the reported earnings, they go up and down again.
Yep.
So which basically means that today's stock fair value is much higher than the future fair value will be. So
True.
we will not buy the stock because last 4 quarters earnings were very high if you know that they considerably drop in the future.
So what we're expecting is for the stock price to come back down to fair value around here. Let's remove earnings per share and fair value so we don't have to get distracted by those. So just adjusted earnings per share and the fair value is the brown. So this is what they're expecting, and that is a loss right now.
Exactly. I think that we can say two things. One thing is that all three remaining fair values are more or less close to each other. Even the fair value based on reported earnings. If you add it back again, then you see that for the estimate of the current business year and for the next business year, it's very close to, or it's close to the other fair values also.
Yep.
For the business year 2021 and 2022. Yeah, it's just for the present where it's a complete outlier, which makes it unusable. That's
Right.
one point. The other point, you just show us with this red line you draw, is that because the fair values for the current business year, also for today, are lower than the current stock price, it means that there is a risk of potential capital losses if the market or if the stock price comes back to these fair values. So first, don't expect much more capital gains. This means it's more probable that capital losses in the short run, so in the current business year, for example, will happen.
Okay.
Mm.
Okay. So this is the next step beyond the ranking system that I have, because you're actually taking these estimates and putting them in a format that you can actually use instead of just numbers in a chart. Even just looking down here, this is really hard to see. A chart like this makes it really easy, a lot easier, I should say. So this is why I appreciate it. This is great.
Yeah.
Okay, we do have at least one person watching. David Womack mentioned that the boost in Activision that we were talking about may have been from the sale of a video game, or a pre-sale. That's where the extra cash flow might have come from, and that's their business model. That's what they do. Let's see what he was talking about. Let's go back to Activision Blizzard and bring in operating cash flow. So this cash flow here from 2015 through 2017 was a massive increase. And he's saying that that might have been a pre-sale of a video game, which then came out, and they don't have anything else really going on right now, so their cash flow is going down again. That's again speculation.
Thank you. Okay.
Okay.
Yeah.
So the website has 1,017 stocks. Let's clear that out. You can filter down a number of different ways. By country, you can select an individual sector. You can narrow down to a particular industry. The others, you can specify a type of market capitalization. If you only want the ones above 50 billion, earnings stability is something that we can get into later.
Yeah.
A lot of these are calculations, right?
Yeah, exactly. Basically, all these filter criteria are based on the matrix you have in the screener. So it's nothing special if you want. So I think all screener do the same in this regard.
And this is what has gotten me really excited, because I'm realizing that a ranking list is helping me answer the question, what do I buy next? And I just go down through my rankings. I'm going to start doing evaluations on these to see which ones are overvalued or undervalued. And I think I want to try and figure out how to incorporate that. But your screener is the first one that I've ever seen that actually incorporates the idea of a ranking system into the stock screener itself.
Yeah, because from a technical point of view, it's not so easy. Normally, it's HTML tables and the screener itself, from a technical point of view, is an HTML table, and normally they are not editable, and they are more or less stable.
Right.
And here, this one isn't. It can it changed its input. For example, on the ranking column, this makes it dynamic.
So based on the rankings that I have here, which I think are the defaults, the rank column in the list is showing how these different stocks rank based on this criteria. So let's hit it once for ascending and then descending. So the rank 100 comes to the very top. This is showing that AbbVie and British American Tobacco, based on these particular ranking setups.
Exactly. I should mention maybe that this ranking setup, it's a predefined ranking setup, and it shows a dividend income strategy. So it simulates a person which wants high dividend or is searching for stocks paying already now high dividends.
So an income portfolio, a current income portfolio.
Exactly.
Okay.
So stable earnings, stable cash flows to make the dividends reliable, but also dividends pay at least 2% dividend yield, I can see, but dividend growth more or less modest with 5% a year. And yeah, basically that's
Stability, capital gains expected at 5%.
That's valuation criteria, exactly.
Okay.
And then you see that all these stocks here are paying high dividends.
So if you create an account and you set your own, or you use this default for an income strategy, then you can come up here and say, I don't want to deal with international if I'm in the United States, or I don't want to deal with United States stocks. I want to just focus on the ones in the United Kingdom, things like that. So I'm going to isolate it down to just the United States.
You can do so.
And then minimize the filter again. And let's see. So these are only U.S. stocks now.
Exactly.
And so these are the ones that I want to evaluate. And so then you can click on them and you say, okay, so let's look at the valuation and do that kind of analysis. Are they undervalued or overvalued right now? And where are they going to go, and where could they go? So let's say that the fair value based on adjusted earnings takes it about here in 2021. So what would that do to my portfolio if the stock went from where it is now to where the estimates think it might be based on adjusted earnings per share? That'll give me this kind of an increase. So $1,000 would give me 733 in increase.
Exactly. Even dividends on top. So the stock seems to be undervalued, obviously.
Yeah.
At least for the time range, which is the default. We should, but it should be okay for this overview.
So Broadcom is another one that was high on my ranking system for a long time. How is that one doing? Okay, so here's an interesting one. The dividends have been growing like crazy. Right now, it is about here. It's about where the adjusted earnings per share estimates think it should be. But if somebody is looking for it for a dividend stock, they might be thinking it's undervalued because what they're going to be getting from the dividends is going to continue to increase, at least according to the estimates.
Maybe you show our visitor, David, I think he's called, the dividend turbo. Then you can see better what you just told us, that the dividend yield, the current dividend yield is much higher than in the past. Dividend turbo is the tab on the right of the valuation tab. Yeah, exactly. You see how dividends increased, or the dividend yield increased. You can see both.
Okay.
Increased dividend yield and increased dividends. On the bottom, you see the cumulated dividends for always the last 12 months.
Okay, so what is the range here? Lower estimate, general estimate, and high estimate? Is that what I'm looking for?
No, it's based on the standard deviation for 12 months.
Got
So
it.
it's a 12-month corridor, and I think it's two standard deviations, something like this. Honestly, I already forgot how many, but
Okay.
it should be 2 or 2.5.
So the line, the dark blue line here is the actual dividend yield, correct?
Mhm.
Okay.
Exactly.
So
Should be in the manual written. Meanwhile, it's so complex that I should consult my own manual.
okay, so I think what we're seeing here, this is just the dividend yield and
Exactly.
the dividends paid out. Okay.
Exactly.
If we want to look back for a 12-month period, that is this range. This is looking back 12 months from whatever point in
Mm,
time.
the medium line you see is the simple average of the last 12 months dividend yield. That's the medium line.
Okay.
And then on the top or on the left, there's a range, and the range is calculated by using standard deviation. I'm
Okay.
just not sure right now if it's 2 or 2.5 standard deviations, but it doesn't
Okay.
matter for us
No,
now.
it
It's just
doesn't.
a helper, a
That's
helper trying.
details.
Yeah.
So that's 12 months. This is the same view, but taking that out 2 years.
Exactly. And then, because the dividend increased sharply, the average lags behind because it takes the last dividends or dividend yields of the last 24 months. And so the average becomes lower than for the last 12 months. Because 2 years ago, the dividend yield was lower than 1 year ago.
Right. And here's 5 years. So
Uh,
this is taking into account they had
mm,
slow growth for a very long time, then they started picking up. So that pickup starts here
yeah,
and continues up.
yeah.
So the
But
5 years, and then we can also do the same thing for 10.
Yeah, but it makes no sense. I think 2 years, 5 years, 10 years, these corridors don't make sense for this stock because dividends grew so sharply that what happened 4 or 5, 10 years ago doesn't matter. It's not characteristic for today's yield anymore.
Okay.
So we should work with the 12-month corridor. But again, these corridors, they are only little helpers for you
Right.
for the visualization.
Okay.
Mm.
Well, we've been on for almost an hour and I've
Hey,
learned a lot. I
I
hope the
must go
viewers have as
to
well.
bed. It's already late in Germany.
Yeah, it is. Okay. So, like I said at the beginning, we were planning to do this both live to the Facebook page and to my YouTube, to the YouTube channel, Total Growth Investing. That didn't quite work because projecting to both destinations is a paid service, and we're not quite ready for that. I think we'll try just to the YouTube channel next. Maybe do that
Mm,
tomorrow, or no, not tomorrow because you're busy tomorrow.
exactly.
But
After tomorrow.
okay, so we'll try that again, maybe on Friday, and we'll project to the YouTube channel and see how well that works.
Is there any instantaneous feedback from our single viewer, or maybe 2 or 3 even?
I don't see any more comments, so I don't
Okay.
know if they're still watching.
Okay.
We'll find out, and this is going live, and I'll keep it in archive. But I know I learned a lot on your website
I,
and a lot
I,
about
I'm
acquisition,
sure this is
Logitech,
I'm
etc.
sure this is a hidden game. What
Yep.
we are doing here, it's a hidden game. Yeah.
So we will be
Mm,
back on Friday on YouTube, and I will be back on the Dividend Growth Investing live stream tomorrow morning at 9 o'clock. I hope
okay.
everybody enjoyed,
What
and
a pleasure with you, Chad.
it's great to learn, and it's great to work with you across the Atlantic like this. It's fun.
They're the same.
Okay, we will see everybody on Friday.
Bye bye.